Assalamu alaikum. I hope you're doing well. In times like these when the market is falling, and right now we are in bear market territory, the question that is top of mind for many investors naturally is, when will the market reach bottom? When is it safe for us to start buying again? And in this video, I'd like to share with you 3 different metrics that have historically been good indicators of market bottoms. So without further ado, let's get right into it. The first of these indicators is the S&P 500, which is one of the most commonly followed equity indices, and it represents 504 of the largest companies in the United States. This index, that is the S&P 500, has only fallen 10% in a single month 9 times since 1957. And if we look at the month of June, from peak to trough, there was a decline of more than 10.5%. And historically, 8 times out of the 9 that the S&P 500 has dropped more than 10%, it yielded a positive return on investment within less than 10 months. So if we look at these instances in detail, we can see that, and by the way, these numbers are from the datadriveninvestor.com. So if we look at March 1st of 2020, there was a decline of 12.5%. If you bought at the end of March, you would have been in profit in April. And by July of 2020, you would have been in profit 24.5%. In 1998, if you had bought at the end of August, after it had dropped 14.58%, you would have been in profit the very next month. And by December of 1998, you would have a profit of close to 25%. In 1987, if you bought at the end of October, after the market dropped 21.76%, the next month you would still be in the red. And by January of 1988, you would be in the black, you would have profit. And in 2008, if you had bought at the end of October of 2008, after the market had declined close to 17%, you would only have to wait 9 months before you were in profit. Mind you, this is one of the largest market crashes in recent history. In 1980, if you had bought at the end of March, when the market had lost 10.2%, you would be in profit the very next month. And in September of 2002, if you had bought at the end of September, when the market had lost 11%, you would be in profit the very next month. And in 1974, if you had bought at the end of November, after the S&P had lost 11.39%, and you waited around 10 months, you would be in profit in October of 1974 to the tune of 16%. Now, just because things happened a certain way in the past doesn't mean necessarily that they're going to happen in the same way in the future. That said, I do think that history is useful when trying to put the present in its proper context. And by the way, if you are enjoying this video, do me a favor and leave a like. I'd really appreciate that. The second indicator that I want to share with you is the VIX index, or the volatility index. The VIX index is a measure of how much volatility there is in the markets. And typically this volatility is viewed as a proxy for the level of fear that's in the market. So the VIX currently is right around 30. Measures between 20 and 25 are associated with a volatile market. Anything above 30, and we're talking about a market that is characterized by fear. And so far in 2022, we have been above 30 numerous times, and we've actually touched 35 a few times since the beginning of the year. Historically, investing during periods of higher readings for the VIX index has been associated with higher returns. And if we look at when the market has bottomed historically, or reached the bottom, typically the VIX reaches levels between 40 and 45 before the market bottoms out. So if you look at 2007, 2008, the VIX reached well above 40. The same is true in 2011 when we had a correction. The same is true in 2020 when the coronavirus first hit. And some are looking at today's VIX index readings and saying, well, we haven't reached that 40 to 45 mark yet, so perhaps we haven't reached the bottom of this downturn yet. However, it's important to keep in mind that these are simply correlations. They're not causations. It's not necessary for the VIX to reach 40 to 45 before we bottom. And also, reaching 40 to 45 doesn't necessarily mean we are at bottom. We could go much lower even after reaching those levels. So again, these are indicators. They're not 100% guarantees of what is going to happen. If you'd like to follow when I buy, how much I buy, of what, then consider becoming a PIF member. Link to do so is in the description. You can follow my investments, and also there's a whole host of other perks that you are privy to, including YouTube lives on weekdays. The third indicator that I want to share with you is again related to market sentiment, just as the VIX is, but it's a more direct measure of market sentiment, and that is the American Association of Individual Investors Weekly Sentiment Survey. And this has proven to be a somewhat contrarian indicator, wherein above average market returns have often followed unusually low levels of optimism, while below average market returns have often followed unusually high levels of optimism. Currently, as of the week ending 6/29/2022, 22.8% of surveyed investors think the market is going to be higher in the next 6 months. 46.7% think that it's going to be lower, which is a big improvement in sentiment compared to the week prior, wherein only 18.2% of individual investors were bullish on the markets in the next 6 months, versus close to 60% of investors who were bearish about the market in the next 6 months. And these numbers are, in terms of bullishness, well below historical averages, which have been around 38% of investors being bullish versus 30% only being bearish. And the 1-year high really corresponded quite well with the peak of the market, was around 48%, and that was for the week ending 11/10/2021. And it should serve as a healthy slice of humble pie for individual investors to see that their sentiment about the market is actually a contrarian indicator. If we look historically, when bearish sentiment has been close to 60%, which it was in the middle weeks of June, as we saw, which is basically +3 standard deviations above its average. When that was the case, the average return in the S&P 500 has been around 25% over the next 6 months and 35% over the next 12 months. So these are 3 indicators that I like to look at when I'm trying to ascertain how close we are to the bottom. Obviously, as I mentioned, it's worth repeating, these are simply indicators. They are correlations that have happened historically. They are not causal in nature, so one cannot really rely on them to make guarantees about the future. But they are pieces to a puzzle, and as an investor, you have to put a large number of pieces together and allow for a generous margin of error. As the saying goes, the market can remain irrational a lot longer than investors can remain solvent. So make sure you're never investing money that you can't afford to lose. And with that being said, if you'd like access to live sessions on days when the markets are open with yours truly, consider becoming a PIF member. And in addition to those live sessions, you'll get a bunch of other privileged content, and you'll be able to follow my investments move for move. If you'd like this video, make sure to leave a like. I'd really appreciate that. Subscribe for more content like this. And until next time, make sure to take care of yourself. Assalamu alaikum, and peace be upon you all.